When Goldman Sachs speaks, the market pays attention. The firm's reputation for sharp analysis and market-moving calls means that even a subtle shift in their outlook can send ripples through the financial world. So when Goldman downgrades a major player like Helleniq from neutral to sell, it's not just a routine update. It's a statement that can shake investor confidence and trigger a wave of reassessments across the sector. This move signals Goldman expects Helleniq's stock to fall, driven by mounting concerns over shrinking refining margins and a weakening petrochemicals market. The global energy landscape is shifting, and companies like Helleniq are feeling the pressure from multiple directions. The bank's earnings forecasts for Helleniq in 2026 and 2027 are notably lower than the market consensus, suggesting that investors may be too optimistic about the company's future prospects. Goldman's analysts see potential risks that others might be overlooking, especially as market conditions evolve. A sell rating from Goldman isn't just a mild warning. It's a clear signal that the stock faces significant headwinds. For many investors, such a downgrade can prompt immediate action, as it often precedes further declines. The downgrade highlights a core issue. The market may be overestimating Helleniq's ability to sustain its recent strong performance. As the industry faces new challenges, maintaining momentum could prove difficult. For investors, this is a crucial moment to reassess their positions. It's a time to dig deeper into the fundamentals and consider whether the risks now outweigh the potential rewards. Goldman's analysis points to a tougher road ahead for Helleniq, both in terms of sector trends and company-specific challenges. The company will need to adapt quickly if it hopes to weather the storm and regain investor trust. In the world of energy stocks, such a call from a major bank is a red flag that can't be ignored. Investors would be wise to pay close attention and prepare for potential volatility ahead. To grasp Goldman's concerns, you need to understand refining margins, the difference between what refiners earn from selling fuels and what they pay for crude oil. In simple terms, it's the profit a refinery makes for every barrel processed, after covering the cost of raw crude. This margin is a crucial metric, acting as a financial pulse check for the entire refining industry. Wide margins mean big profits. Narrow margins squeeze earnings. When margins are high, refineries can invest in upgrades, pay out dividends, and attract new investors. But when margins shrink, even the most efficient plants can struggle to stay profitable. These margins are the heartbeat of any refining company, dictating profitability and investor returns. They influence everything from stock prices to executive decisions, and even impact the broader energy market. Margins fluctuate with crude prices, demand for fuels, and global events, making them a moving target. Geopolitical tensions, supply chain disruptions, and seasonal demand swings can all send margins soaring or tumbling in a matter of weeks. Recently, refiners enjoyed unusually high margins, but Goldman predicts this boom will end after 2025. The industry has been riding a wave of strong profits, but such cycles rarely last forever. As demand normalizes and supply disruptions ease, margins are expected to shrink back to historical averages. This means the extraordinary profits seen in recent years are likely to fade, returning the sector to more typical, less lucrative conditions. For Helleniq, whose profits soared on these wide margins, normalization could mean a sharp drop in earnings. The company's recent success has been closely tied to these favorable market conditions. This is the crux of Goldman's downgrade. The era of supercharged profits is likely ending. Companies that have grown accustomed to these windfalls may face tough adjustments ahead. Investors who don't factor in this shift risk being caught off guard. It's a reminder that the refining business is cyclical, and fortunes can change quickly. In short, refining margins are everything, and Goldman sees them heading lower. The outlook for the sector is shifting, and so should investor expectations. That spells trouble for companies banking on continued high returns. The days of easy profits may be numbered, and strategic planning will be more important than ever. Understanding this dynamic is key to making sense of the sell call. For investors, keeping a close eye on refining margins could make all the difference in navigating the sector's next chapter. European refiners have thrived on sky-high fuel prices, benefiting from a unique set of market conditions that sent profits soaring across the continent. Crack spreads for diesel and jet fuel reached record levels in late 2025, reflecting both surging demand and tight supply. These spreads, which measure the difference between crude oil costs and refined product prices, became a key driver of refinery profitability. Helleniq's own refining margin jumped 30% in just one quarter, fueling not only strong earnings but also generous rewards for shareholders. The company's performance became a standout example in the European energy sector. But these impressive numbers were driven by exceptional circumstances: geopolitical tensions disrupting supply, a surge in post-pandemic demand, and ongoing supply chain issues that limited fuel availability. According to Goldman Sachs, this extraordinary environment won't last forever. The bank expects crack spreads to decline in 2026, though they don't foresee a total collapse, just a return to more typical levels. The party for refiners is winding down, and the market must now adjust its expectations for future profits and growth. High margins have propped up stock prices, but as those margins revert to normal, so too will company profits and investor enthusiasm. Helleniq's recent success was built on a rare set of tailwinds, including favorable market dynamics and external shocks that are unlikely to be repeated soon. Goldman's analysis suggests those tailwinds are fading fast, and the industry must prepare for a more challenging environment ahead. Investors betting on a repeat of 2025's boom may be disappointed, as the factors that drove those gains are unlikely to align again in the near future. The normalization of margins is central to the sell thesis, as analysts expect profits to settle at more sustainable, long-term levels. The golden era for European refiners is likely ending, ushering in a new phase where adaptability and efficiency will be more important than ever. European refiners like Helleniq face structural disadvantages compared to their global peers. Access to preferred crude grades is shrinking, driving up costs from the outset. Energy costs, especially for natural gas, remain much higher in Europe than in the US, squeezing margins further. On top of that, Europe's aggressive carbon pricing adds another layer of expense. These factors combine to make refining in Europe a tougher, more expensive business. Helleniq's cost base is rising just as profits are set to fall. Competing globally becomes harder when your raw materials and energy are pricier. These headwinds are a big part of why Goldman is bearish on Helleniq. As profits are set to decline, Helleniq's spending is rising. Goldman Sachs now expects the company's capital expenditures to hit $620 million in 2026, up from previous estimates. The main drivers: a push into renewables and a major refinery maintenance turnaround. Investing in green energy is essential for the future, but it's expensive up front. Maintenance shutdowns are necessary but costly, both in cash and lost production. This double whammy of higher spending and lower earnings puts pressure on free cash flow. Investors watch this metric closely. It determines the company's ability to pay dividends or reduce debt. Helleniq faces a financial squeeze at the worst possible time. Rising costs and falling profits are a tough combination for any business. Goldman's analysis highlights a stark reality. Helleniq's projected 2026 free cash flow yield is just 2%, far below the 9% average of its European peers. This low yield means investors are paying a premium for less cash return. The squeeze comes from both sides, shrinking earnings and rising capital spending. Goldman's earnings forecasts for Helleniq are also below market consensus, reinforcing the case for caution. For value-focused investors, a 2% yield is hard to justify when better options exist. The numbers make the sell call clear. Helleniq looks expensive relative to its cash generation. In a sector where cash flow is king, this is a major red flag. The financial modeling points to a tough road ahead. Goldman's new 12-month price target for Helleniq implies an 8% downside from current levels. This isn't just a number, it's a warning that holding the stock could mean losses in the year ahead. The target reflects all the headwinds, lower margins, higher spending, and weaker cash flow. For current investors, it's time to reconsider. Do you trust Goldman's analysis or bet on a market rebound? For potential buyers, the message is clear. Wait for a better entry point. A sell rating from a major bank is a serious caution flag. In uncertain times, it pays to be selective. Despite the downgrade, Goldman Sachs recognizes Helleniq's strengths. The company is well run, with efficient refineries and strong operational execution. Its marketing business is improving, providing a more stable earnings base. Investments in renewables, while costly now, position Helleniq for the future. The downgrade is about valuation and industry cycles, not management quality. Helleniq's diversification efforts are a positive sign for long-term sustainability. The company's resilience and adaptability shouldn't be overlooked, but for now, the financial headwinds outweigh these positives. For context, Goldman Sachs maintained its rating and price target for motor oil, Helleniq's closest Greek rival. This contrast highlights that not all refiners face the same risks or valuation concerns. Motor oil may be better positioned or more conservatively valued, according to Goldman's analysis. The decision to downgrade Helleniq, but not motor oil, underscores the importance of company-specific research. Investors shouldn't paint all European refiners with the same brush. The details matter, diversification and careful analysis are key. Even in a tough sector, opportunities remain for those who dig deeper.